If you're young, $100,000 is a terrific place to start your retirement portfolio. But how much money can you anticipate to make with that amount of money? Would it be suffice to cover your car payment, your mortgage payment, or perhaps your retirement income? Perhaps seeing that consistent revenue hitting your account, regardless of whether or not you're working, would be enough to give you peace of mind. You might be amazed at how much you could get from a $100,000 account according on your investing style. Examine how much dividend income that could generate and how you can enhance profitability to achieve your objectives faster. Our company, Fortune Fastlane, teaches people about money, personal finance, and investing. If you want to improve your financial future, subscribe to the channel and hit the like button if you found this video beneficial. It goes without saying that the amount of money you earn is determined by where you keep your money. You could put your money into a wide market index fund that tracks the whole S&P 500 to maximize growth and income. You might buy individual dividend stocks or a combination of both. Dividend yields will vary depending on how aggressive your portfolio is and how long you want to work before retiring. You don't want to be completely invested in income investments long before you want to retire, simply because dividend-paying companies offer lower total returns. This is due to the fact that they are not fast-growing businesses, but rather established blue-chip alternatives. High income is nice to have, but for younger investors, it is largely irrelevant. S&P 500. If you put $100,000 into a fund that tracks the S&P 500, you may expect an average level of dividend income, indicating the fund will be geared toward both income and growth. Your income and overall returns, including capital appreciation, will be average because you're purchasing the market. The S&P 500 now offers a dividend yield of roughly 1.5%, which means you'd get $1,500 in dividend income per year, or $125 per month on average. Payments are usually made on a quarterly basis, which equates to $375 every 3 months or every quarter. While the dividend yield isn't very high, the overall return is around 10% on average per year. For the average investor, receiving this form of dividend income is great, since it delivers a near-perfect combination of income and growth and income. Even if someone spent all of their dividend payments right away, their investment would still rise significantly over time. S&P 500 Growth Fund. An S&P 500 Growth Fund could be used to obtain a higher growth rate, but smaller dividend income. A fund like this would invest in the fastest growing companies in the S&P 500. This is ideal for those who don't intend to retire for a long period and don't rely on dividends, because many of the holdings are technology companies that pay little or no dividends. The yield will most likely be under 0.5%. With a $100,000 investment, dividend income is only $500 per year, $41 per month, or $125 every quarter. The capital appreciation will be larger than usual because the companies are fast-growing businesses like Apple, Microsoft, Tesla, Nvidia, and Google, despite the fact that this is a minor factor. Because they prefer to build the firm rather than distribute revenue to shareholders, these companies pay relatively minimal dividends, if any at all. Because dividend income is only 1/3 that of the S&P 500, you'd have to invest 3 times the amount to get the same amount of income. However, due to the fast rate of growth, you may be able to reach that amount considerably sooner. If you want to increase your dividend income and don't mind a lower overall rate of return, you might want to explore investing in a fund that is particularly designed to deliver higher than average dividend income. SPDR'S S&P 500 High Dividend ETF is a superb example of this type of fund. It invests in firms in the S&P 500 that have the greatest dividend yields. Because the companies invested in these funds are focused on delivering stable earnings and income for shareholders rather than trying to scale, they virtually always experience modest capital appreciation. Keep in mind that even when dividend payments are factored in, returns will likely to be lower than a higher growth option. As a result, this sort of investment is typically only recommended for those who require immediate retirement income and don't have the time to wait for investments to increase before drawing income. Buying individual dividend equities. Some investors prefer to buy individual dividend equities that fulfill their requirements. Everyone has their own preferences when it comes to stock features, but dividend investors often look for stocks with a history of dividend increase. They also want future dividend growth to go along with increasing earnings and profit to ensure that their stock price rises. A dividend company that pays 10% but loses 20% of its value every year is a lousy investment, yet many inexperienced investors are drawn in by the high yield. Individual stocks are the riskiest option, but they also provide the greatest potential for profit. Because share prices vary independently, it's simple to detect a stock that's on sale for a variety of reasons. Some stocks, on the other hand, are similarly overvalued. When buying funds, it's difficult to obtain a good deal because all of the stocks are priced the same. The ability to buy a single stock on sale is what attracts investors the most. Consider it like buying a fixer-upper for a fraction of the cost with a huge profit potential. It's simple to snap up the decrepit house on the market, while the lovely home on the other side of town commands a premium. Iron Mountain is an example of a single dividend stock. Their business is information and asset storage, protection, and management. Because it's a REIT, which is normally the sort of company with the biggest deal, it's one of the top yielding companies in the S&P 500. It offers a 7% dividend, which means you'll get $7,000 a year or $580 per month in dividends, which is a substantial sum. And hopefully the share price will continue to climb, giving investors an excellent return on their investment. Its earnings don't increase as fast as its counterparts, but most people would buy it for the dividend income. It's not a good idea to put your entire portfolio in one single stock. Iron Mountain is a good example of something you could potentially buy and earn a decent amount of money for doing nothing. Furthermore, if you have a portfolio of perhaps 10 high-quality stocks, the chances of one of them going on sale at any particular time are high, so you can always get a good deal. The quantity of dividend income earned by a portfolio of this size isn't particularly large. That isn't to suggest that some people wouldn't be content with this amount when supplemented with another source of income, such as a part-time employment or Social Security benefits. Given that the average monthly Social Security payout is around $1,500, an extra few $100s and spending money is appealing. A couple with a paid-off home and moderate expenses might be able to live well on Social Security. Aside from dividends, there are also other sources of income. If a retiree works 20 hours per week at $13 an hour, that's around $1,000 per month, and dividend income would be excellent to supplement that. It might be enough to cover transportation costs, a vacation fund, or even a tiny house payment if nothing else comes up. Even if they aren't especially large sums of money, the power of dividends reinvested over time can be enormous. Younger investors are becoming more interested in dividend investing, but they must keep their objectives in mind while determining the best plan that will offer them with the most money when they decide to spend it. Should you put your money into income investments that follow the market or growth investments that surpass the market? A broad market fund such as the S&P 500 may provide the best of both worlds. Consider how much dividend income you may expect from each of these distinct type of assets. Then you'll know what investment technique to use and the amount of money required to meet your income goals. That's it for this video, Fortune Fastlaner. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon.